Everybody, David here. Hey, wanted to reach out to you. I know we sent you an email earlier this week from Schwab, just talking about the strength of Schwab and how your money's safe and sound. But I wanted to give you kind of an update on just my thoughts on what's going on a little bit, not too deep, and talk a little more about Schwab. But yeah, obviously it's been pretty unnerving watching these regional banks like Silvergate Bank, Silicon Valley Bank, and now First Republic have some issues. And so I kind of want to talk a little bit about that. And what happened really is you basically had an old-fashioned run on the bank. Each of these banks kind of had their own issues, but kind of an underlying issue specifically with Silicon Valley Bank was that they basically had kind of an asset liability mismatch. And what I mean by that is that banks make money by taking your money in, paying you as least amount as possible, and earning as much interest as possible. That spread is how banks make money. We also have what's called a fractional banking system, where they have to keep on reserve about 10% or 10 cents of every dollar that they have in your account. So it's a leveraged system. So most times when people take money out of their bank, it doesn't really affect the bank. Well, there's a couple unique issues with Silicon Valley Bank. About 95+% of their depositors had assets in the bank over the FDIC limit of $250,000. That's quite unusual. This was a bank that attracted hedge funds, venture capitalists. It's in Silicon Valley. Very, very high net worth billionaire clients, multi-millionaire, ultra high net worth clients. And so when word got out that there were some issues, then good old fashioned run on the bank, these deposits started coming out. Here's the problem. Those deposits are a liability to the bank. Your bank deposits are a liability to the bank. And they have to offset that with some assets. Well, typically what's happened and what Silicon Valley Bank did in particular was bought more longer-term mortgages and longer-term treasury bonds. So the problem with that is like any investor, let's say you bought a bond 3 years ago and you were getting paid 1% on the bond, right? 2% on the bond. Well, rates are now, let's say, 4%. So what happens when rates rise like that, the value of the bonds go down. Well, let's assume it's a treasury bond. It's a 5-year treasury bond. Well, if you hold that to maturity, then there's no loss in that account. You get fully paid the principal and interest that you invested in, right? So you get your money back. Well, if you have a run on the bank and they're forced to sell those assets, those bonds, those mortgage-backed securities prematurely, you have a giant hole. And I heard it was around 20% plus. It was kind of like last year with bonds. I mean, last year, if you owned a lot of bonds, as most of our clients didn't, you could be down 15, 20%. Well, the bank faced the same situation. As rates rise, the value of bonds, especially long-term treasuries and mid-term treasury bonds, can lose more value. And so that's what happened. So they had to start selling these treasury assets, these mortgage-backed security assets at losses, and that just was kind of a self-fulfilling prophecy, and the bank went under. It got taken over by the feds. So that's kind of what happened there. And so I'm sure you've heard a lot about this in the news already. I just wanted to give you my own, hopefully simple language. They had assets that were undervalued. It's called mark-to-market. The banking system, the Federal Reserve, doesn't make them mark-to-market or make them value those assets at today's price. If it's a treasury bond, treasury bill, something like that can be held to maturity where they're promised to get their money back. But the problem is when you're in a rising rate environment and you have a run on the bank and have to sell those assets, that's where the problem lies. So, this is one of the side effects or the knock-on effects with rising interest rates. And so, I think enough on that. I just wanted to give you some context on that. But more importantly, our clients' money, your money is at Charles Schwab. We're very comfortable with that. They're one of the largest custodial institutions in the world. Not only is there FDIC insurance in the accounts, there's what's called SIPC, which is for securities and cash as well. They also have a supplemental policy with Lloyd's of London for $150 million per account. And so, those are all the things. And these only come into play if there's a liquidation. So if Charles Schwab went bankrupt, then these insurances would kick in. So really, there's not an issue with that. Charles Schwab is a very sound financial institution. That's why we're with them. And the fact is, the government right now is backstopping all these non-FDIC assets at all these regional banks as it stands right now, regardless. So hopefully that helps. The last thing I'll say is we don't have any direct investment exposure to regional banks at this point in time. Those of you in our dividend portfolios, these are all large institutions. We own a couple bank stocks in some of our portfolios, like JP Morgan, I think Goldman Sachs, but again, it's part of a diversified portfolio of dividend-paying stocks. But we have very little exposure even to the banking sector at all, but no exposure to the regional bank sector, which is where the problem lies. And quite frankly, most of, a lot of our clients' assets are in individual treasury bonds right now and in money market accounts. So very safe, conservative assets given market conditions. So hopefully this helps a little bit. I just felt the need to at least speak to you personally. If you have any questions or thoughts or comments or concerns, just reach out to myself or Julie, and talk to you soon. Take care.